Welcome to On the Edge, a show examining how deals actually happen in commercial real estate. Host Malcolm Davies, founder of Way Capital, speaks with professionals in development, investment, finance, and more for insights into how these business leaders get deals capitalized. Malcolm's career spans more than 20 years, during which time he has managed nearly $20 billion worth of financings. Now to your host, Malcolm.
Hey everyone, welcome to the next edition of On the Edge, a monthly podcast that we love to host where real estate deals get put together and unique things that are really important are discussed. So I got my great friend John Drachman with Waterford on the show this month, and we're excited to have him. So John, welcome to On the Edge.
Yeah, thanks for having me. Obviously, always fun to be on a podcast with a fellow Arizona Wildcat.
We were just talking about our Wildcats making the College World Series in baseball. So nothing binds people closer than alma maters. Although I think we miss each other by just a couple years. But I will say this, you and I talk about it all the time. So we live and die by our Wildcats.
We do indeed. Hopefully, maybe when this is posted, Arizona won the College World Series, right?
You know what? I'll tell you what, I'll just call it here. We won.
Okay.
All right. So tell us a little bit about yourselves, John. You know, I've known you forever, but at the end of the day, you know, Waterford is involved in a lot of unique things. And I think your personal career is super interesting.
Yeah.
You know, going back a number of years prior to Waterford, and also what you do in being an educator as well. I think, you know, that's an element that you're not only excellent at, but the last part is you're quite good on the social media chain. So we love to read the things that you post about. So maybe give everyone a little bit more backstory about John, his career, and how'd you got to where you are today.
Sure, happy to. You know, and I've said this a couple times in some of these podcasts. So if anybody's watching another one of them, they're bored of me telling my career. I'm sorry, but you know, I'm born and raised in Orange County, so I grew up in a city, Irvine. You know, played water polo growing up, and when obviously, I chose to go to the Harvard of Southern Arizona for school, the University of Arizona. Had a great experience there. When I moved back, I have some family on my dad's side that were actually involved in real estate development. So my family is actually one of the original settling families of the state of Arizona, specifically the city of Tucson. I don't know if you knew that, Malcolm, or not. Have we ever
I didn't
talked
know that
about
at all.
And so, and my great uncle was a very prolific or a very well-known retail developer named Roy Drachman. And when I went to the University of Arizona, I got to know him well before he passed away. And that was really my first taste of real estate. My dad has been in technology sales his whole career. And so I didn't really know anything about real estate until I really got to know my great uncle Roy, saw his career, and it really intrigued me. So when I got out of undergrad, I actually started a company for about 10 months because I did the entrepreneurship program at the University of Arizona. It didn't work out that well. And then I went to go work for a home builder through a relationship with somebody I knew from the University of Arizona that was working for Pulte Homes. So I worked there for about a year, and I wrote sales, on-site customer service, rotational training program. I was in a construction trailer for like a month or 2 months. And I really learned a lot about the single family development business in that year I was at Pulte Homes. Like the people I worked with, hated the job. Big public home builders are basically like working for big manufacturing companies. So I didn't like it. Started networking and trying to figure out what other opportunities there were. And that's really when I heard about commercial real estate. And I made a connection and started interviewing with commercial real estate brokerage firms here in Orange County. And I was very fortunate to land a job with Grubb & Ellis, which some of the people watching this might not even have heard of Grubb & Ellis. But at the time, Grubb & Ellis was probably the second largest commercial real estate brokerage firm in Orange County. They had a great office, and I did a runnership under two guys that did office and industrial tenant rep and landlord leasing work. And so I worked for them for about 15 months. I think I made like $28,000, like no money. Yep. My dad always didn't understand it because he's like, so let me get this straight. You're going to go into brokerage. You make no money or very little money. Then when you get done, you're going to become an independent contractor and they're going to pay you zero. He's like, you think this is smart? I'm like, yeah, Dad, I'll figure it out. And so I ended up staying there for about 3.5 years, had a great experience, really enjoyed learning everything I could about, real estate leasing, which when you think about office, industrial, and retail properties, the lease is the lifeblood of one of those properties and where a lot of the value is denoted. So understanding how that works, I thought was great. And then candidly, I've told people that I want to move to the principal side. I'd be a little honest and tell you, Malcolm, that I got a little bored with it. And I really wanted to sort of elevate my career. I've said this story once, I don't know publicly, but I went to a RealShare conference where they had a morning session. They had two morning sessions. The first morning session was on the office leasing markets in Orange County. This is about 2.5 years into me being at Grubb & Ellis. I knew what was going on. I had a good sense. They had a second session afterwards, and it was on the real estate capital markets. Smitty from CBRE was leading it. I think Steve Briggs from LBA was on the panel. There's somebody from AEW, and I can't remember the third person. And they were talking about IRRs, capital stacks, equity multiples, cap rates. I had no clue what they were talking about. And I remember feeling so stupid. I'm like, if I want to be a successful real estate professional, I have to understand what these people are talking about. And that was really the impetus for me thinking about going back to grad school. So I went back to grad school at USC, decided to leave brokerage. And it really was me thinking about, I want to invest in myself. I want to invest in my career. And was there from August of 2007 through May of 2009, which we were talking about before, which obviously was a very interesting time to be back in graduate school. Oh, yeah. And, it was fascinating. I literally took a real estate capital markets course from Professor Raphael Bostic, who's now the head of the Atlanta Fed, in the fall of 2008. There's no amount of money I could go back and repay USC for those experiences, right?
Yeah.
And it was just an unbelievable time to be in school, watching really the real estate market sort of crater. Unfortunately, though, I had to graduate in May of 2009 and in a really tough job market. I moved in with my in-laws, with my fiance at the time, my now wife, and just grinded to find a job. Was doing consulting work, trying to figure things out. And then very fortunately, at the end of 2009, I got a call from a former classmate of mine who said, "Hey, I just had coffee with Will Smith from Greenlaw Partners. He's under contract to buy a pretty big office campus project in Irvine. He's thinking the market's turning and he's going to start buying again. And he's looking for I think the exact words were a smart MRED who's a little desperate, maybe work for cheap. And you should call him." And I met Will through the MRED program. Malcolm, I know you know Will.
Yeah, of course.
And so I called Will and we met, and I was very fortunate to get a job. And I joined Greenlaw Partners at the end of 2009. And they were an owner operator at the time. They've obviously prolifically grown, but at the time really focused on value add, opportunistic office and industrial acquisitions. So this was end of 2009, and I joined them, and Will timed the market really well. And it started at the company, 6 years before that, and went on a really big buying spree with a couple of, large institutional equity partners. And very fortunate that I got to work on acquisitions, asset management, see deals soup to nuts. And I really did whatever Will told me. And over the course of 5 years, I can't tell you how much I learned about how to be an operator, how to raise capital, how to execute business plans, how to, underwrite projects, how to put together business, a thesis on a deal. But, I struggle as an employee. And so I decided eventually to make the leap and go do my own entrepreneurial thing. I say one of the challenges I had with brokerage was I was an independent contractor. Once you're an independent contractor, it's really hard to go be a salaried employee for somebody.
Sure.
So I ended up leaving to go start, at the time, a firm called Stillwater Investment Group, where we were going to buy value-add office and industrial transactions. This is the summer of 2014. And I was very fortunate that I had a good friend of mine, Sean Rawson, who was on his own, who comes from a residential and affordable housing development background, who we were good friends, and we went to lunch when I was thinking about right before I went off on my own. And we were talking about what I was going to do, and I was trying to get his advice because he was about a year before me. And I mentioned that I'd found this small office space that I could lease, but I needed somebody to share it with me. And we went and toured it after that lunch. And the next morning he called me and said, "Why don't we just share an office space for a year and maybe something will come together?" And we started leasing that space August 1st of 2014. So about a year later, we bought our first multifamily value add project together. And then away we went. We've been 50-50 business partners now since 2018. We've done about $3 billion worth of transactions.
Yep.
Post-COVID, we obviously have a heavy emphasis on residential properties, a lot with a pretty heavy emphasis on affordable and workforce housing, so rent-restricted projects using public-private partnerships. But I bought industrial buildings, I bought industrial development land, I bought retail buildings, I bought covered land plays, office buildings, medical office buildings, lab buildings, or buildings converted to lab, market rate housing, affordable housing, workforce housing. So been fortunate to see and do a lot through the course of my career.
I love it. Your story is fantastic. And, really what On the Edge is about is really how deals are put together and how they're capitalized. And we spent a little bit of time when we started On the Edge with more capital providers. Now we're looking at not only capital providers, capital allocators, and sponsors. And we were talking about entrepreneurship before.
Yep.
And it's about where do the entrepreneurs end up going within commercial real estate. And I think we both agreed it's, I'm an entrepreneur. I mean, I got an advisory company. We do a lot of structured deals. And you're an entrepreneur, and you execute and you raise capital. And how do you put those deals together? So chat a little bit about entrepreneurship, how that, that bug hit you, but also just, you have to really hustle in this business to go raise capital and put it together.
Yeah.
Love to understand how you've done that. What are the things you've done to make those deals happen?
Yeah, it's interesting. So as we were talking before, I'm very fortunate. I teach a class at USC in their MRED program, and it's really a class on real estate entrepreneurship. And so it's definitely a huge passion of mine. I always like to say, I don't think, some people have these stories where they're like, oh, I think Sam Zell used to tell a story about like selling Playboy magazines when he was 11 years old, and he'd buy them for $1, sell them for $3. Now, I don't know if I have that story. I always joke, I don't think I'm a great employee. I always joke, I never won a coach's award, right? For my coaches. I was always sort of kind of doing my own thing. And I can be opinionated and like to make sure and kind of really be in control of things. And I think I've always kind of naturally gravitated towards that. But what I tell my students, and there's a lot of people, I think when you're younger in this business that want to do something entrepreneurial, they really want to go strike it on their own. My sense is, and by the way, and at some point, I don't know if he ever does it because he doesn't do podcasts. You've got to try to get Will on one of these. I told him personally, he needs to, because I really learned how you raise capital from one of the people I think is probably on the West Coast, one of the best people at raising money, putting deals together, structuring deals. It's been obviously very, very successful. And so I learned from Will. So obviously, one thing I would advise anybody is if you can work for somebody who's an expert at their game, that can always help you a lot. I think what I learned from him, and I think what I learned from working with a lot of equity partners when I was at Greenlaw, you've got to you really got to put yourself in the shoes of an equity partner, right? And when you're thinking about an equity partner, and it can depend if they're a high net worth investor, if they're a family office, if they're an institutional equity partner. But what I find is they will evaluate the deal, but they're also evaluating you as the sponsor. So if you want to go in the development business or be a joint venture equity operating partner, I should say, the equity partners are going to look at you and say, can you execute on this business plan? Right? Do you have the relationships? Do you have the knowledge base? Do you have the track record and expertise to really execute on things? And I think that from my vantage point, what I see as a big problem in our industry is a lot of people are getting into this business and they don't learn specific knowledge early enough in their career. And they're starting as an analyst and they're doing these, what I would call commodity skill sets, which was different than when I started. Because when I started, there weren't as many analyst jobs, right? And so you started in like leasing brokerage. And I've said this before, but if you think about leasing brokerage, that's specific knowledge, right? Because you're learning why a tenant leases office space in one building compared to the next, how an office lease works. Not a lot of people understand that. And so I think one of the critical components is really trying to build specific knowledge of the various aspects of our business. Because that knowledge base, to me, when we pitch equity on a project, they want to know we have that. They want to know not only is the project and the underwriting work, which, as you know, you can kind of make any underwriting work, They want to know, can you execute the business plan? Are you going to do what you say you're going to do? And that comes down to, do you have the knowledge, right? Do you have that specific knowledge necessary? And so I harp on my students on that. Like, if they're thinking about doing something entrepreneurial, like bring me a deal, I'm like, think about you bringing me a deal.
Yep.
And when we do my class, we do role playing and case studies, and I grind them, I push them pretty hard. And a lot of times I'm going, okay, how do you have the knowledge base to do what you say you're going to do, right? What's your pitch to me that you're going to go buy this medical office building and you've never looked at a medical office building your entire life? You don't know anything about it. Like, that's not a good pitch, right?
Mm-hmm.
So I think it's really about putting yourselves in the shoes of an equity partner and thinking about what they're looking for and then working backwards from there.
So raising money and doing things, I always say there's three really factors. I mean, number one has to be a lot of trust. Number two, that trust has to also be compounded with competency.
Yes.
You have to be incredibly competent,
Yes.
whatever it is that you're doing. And then the final one is, even with trust and competency, you can trust someone who doesn't know anything about anything, right?
Yes.
So that doesn't work, but they can be competent and know everything, but they're not trustworthy. So that goes away. The last part is relationship. If you don't get along with each other, you can't speak to each other. And there are a lot of personalities in our business, right?
Yeah.
It doesn't matter. You're both good people, but if you don't have the same kind of persona, it doesn't work either. So those three things all come together. And reality is, deals, I always just make a joke of this, but reality is, whenever we pitch a deal and they say, oh, I won't do a 6 yield on cost deal, it needs to be a 6.5, right? Then we go back and we say, well, we got a 6.5. And they go, well, it needs to be a 7. What they're really saying is they don't have the trust in the competency with that relationship. And so deals live and breathe based on those three perspectives. And I think, anybody who's younger needs to really think about those three things and recognize that, nothing really gets done without having all of that together. That's why it's difficult.
Very difficult. And this business is a marathon, not a sprint, right? I mean, we're both fortunate to be in the positions we are today, Malcolm. And I know this about you, but there were a lot of times where you were grinding on small things or doing stuff and going through the GFC, no different than myself. And so you have to understand, this business can take a while to build that knowledge base, be able to be somebody who people trust, and put yourself out there and be somebody who's likable and people get along. I do think what's an important point that you mentioned is, you and I both know there's a lot of personalities in this. And so sometimes people think they have to be a certain way to build relationships. I think what you need to be is yourself. I think you need to be authentic with people. I think, my style actually was, different than sometimes Will's style or anybody's style. And so you need to find out who your authentic self is. And where you're right is, you need to find equity partners who share sort of your values, who share who you are, and that you get along with really well. And I think that's, incredibly important too.
Yeah. So let's talk about, really, we've been, unfortunately or fortunately, we've been around a long time, John. We've seen a lot of things. Okay. Yeah. So, this is a very unique part of the cycle. One, and frankly, I would just say that I think you would agree with me, super different. We are not in the GFC environment, but we are also in something more unique in that there are just seems to be channels of winning and channels of losing. The debt markets are interesting. There's a tremendous amount of liquidity. However, that liquidity is only available at the right basis and the right debt yield and the right structure and DSCRs. So how do you see the world today relative to the things that we saw previously? And, try to give the audience a sense of your assessment of things that are happening and how you should play it today.
Yeah, it's last week was my first class this summer. I teach in the summers at USC, and my title slide, after going through kind of the course and whatnot, was my view of the market. It was the best of times, it was the worst of times, right? And I've kind of said that, I think, the last 2 years at the beginning of class, and I'm going, because it's this weird market, right? And I think there's, they always say cycles. Obviously, we talked about this. The cycles happen in our business. This is natural. This is a very cyclical business. They say cycles are always different. They can sometimes rhyme, but they're different. What's so different about this cycle compared to the last one was that last time, as you remember, like, we were in a really bad general recession, right? And that was really caused by, the fallout from the housing industry. And it was so the sentiment was just negative. Like, I mean, I remember going to industry night in February of 2009, where they had a keynote speaker who remained nameless that I still think I'm upset with because his speech was so terrible. And he told us, like, all the graduate students at USC, like, you might want to think about being waiters or like valet cars or be a waitress because real estate's kind of dead. And I don't know what to tell you. Now, the reason I say it wasn't a good speech is because if you think about it, this was the end of February of 2009. I think the stock market bottomed in March. I would argue the property markets bottomed that summer, and you could have bought anything starting in the summer of 2009 and made money on for how many years? 10 years, right? 11 years. And so he was giving us all this negativity when it was like, hey, this is actually the best thing that ever happened to me was that cycle. But in reality, the regular economy was just in shambles. And so what's so unique about this time is, and by the way, remember, they started cutting rates, right? And so this time around, I think what's unique is that the general economy has held up. So property performance has held up better. Now, that's not to say that you aren't seeing issues. Obviously, office, we could do a whole podcast on office, but certainly having a lot of property challenges there as it relates to kind of the work from home policies and COVID. And then if you look at, certain multifamily markets or industrial markets, you're starting to see the impacts of supply issues, tariffs. There's some stuff that's going on where property performance, I think this year is showing signs that it's weaker than it has been the last couple of years. But the property performance has allowed a lot of people to sort of kick the can down the road. And so you haven't, I mean, if you thought this cycle started sometime in the first half of 2022, we're here 3 years later. And I'm like, I don't know when it turns. I don't know what the next 18 months look like. But if we think about the last one, it really started the middle of 2007. By the middle of 2009, I mean, that's how I got hired, is because people started buying again. Now, it was a slow drip, as you remember, because people still held on, but we bottomed much, much quicker. And so I actually think a lot of groups are going to regret extending and pretending, holding on. I think you're seeing with a lot of the syndicators that are out there right now in the multifamily space who wanted to kick the can down the road and didn't want to accept reality when they should have just handed back the keys in right away. So I think what's unique is the way we see it. It's just, you're in a very weird market.
Yeah. And I think, look, when I talk about capital availability, it's all about the right basis and making sure that basis feels protected against an elevated interest rate environment, which there's no reason you would be selling anything for a 3.5 cap or buying anything for 3.5 cap when interest rates are so high. But that being said, one thing I'm noticing, and we've all seen it in the financing marketplace, is that spreads are coming in because there's so much money available that they're being highly competitive. A couple things I want to point out, or just maybe talk through. Coming out of the GFC, also different markets were different. Things I remember basically were all of capital flooded to primary markets.
Coastal markets, right?
Markets are different today. Frankly, Dallas was not what Dallas is today back then. And so the recovery, like in Los Angeles and New York, was much faster. However, recoveries in like Phoenix were much later.
Way later.
So maybe chat about, the things that you see today that we are seeing a little bit of market dynamics in the U.S. today. I mean, you and I are both SoCal folks. It's not going well in a lot of places in SoCal right now as it relates to just things that are happening in the world. But the reality of it is there are some growth markets. Texas has been doing fantastic. Asset classes are in super demand, but then other asset classes are just not. So maybe chat about how the crazy, not only assets, but also geography.
It's weird because when I was at Greenlaw Partners, we bought an office building in the beginning of, I think it was 2012. And we struggled with it. And we bought it super cheap on Camelback, like 29, right near 24th and Camelback, like right where you want to be in Phoenix, super cheap basis. And I would argue we bought it too early. That market didn't really bottom until 2014. We ended up selling at the end of 2014. The next group who bought it did really, really well on it. And I learned that lesson that we bought too early. I mean, I remember trying to do new projects there, and institutional equity would be like Phoenix, click, right? And even within, Southern California, it was like, you want to I'll never forget. We had an office building in that we wanted to buy when I was at Greenlaw, and Aliso Viejo, our equity partner, called it Aliso Vallejo. There's like, I don't know where that is. That just sounds random. Ended up doing really well. But my point being is that what's unique is everybody went to the coast. That's where a lot of the demand, the urban areas and the coastal markets where the demand drivers are. And this, by the way, this gets into, this is where the real estate world is a cyclical place.
Yes.
Because you think about it now, you think about, imagine putting capital out in downtown LA, right? Very difficult right now. You think about San Francisco, you're starting to see a bottom there, but still, I was actually there yesterday. It was actually I thought it was in a lot better shape than I think people would give it credit for. And it's really improved, and I saw a lot more activity, but still, that was the bell of the ball from about 2010 to when COVID hit. And now it's completely reversed. And markets like Dallas and Nashville and Austin and Phoenix, those were markets nobody wanted to be in. But I think really where you've seen this changing demographics of people moving to those markets still growing. And I think I heard a stat that in basically the developed world, Europe, a lot of Asia and North America, the Sun Belt is the only place that's showing population growth still. Yeah. And so, real estate isn't that hard. If you follow population growth, generally speaking, that's not a terrible place to be, because if you think about it, if your population's growing, you need more apartments, you generally need more industrial buildings, you need more retail. I don't know about office, because office is a whole nother ballgame, but it's definitely different. I mean, we've expanded into Texas recently, and I would argue raising capital. I mean, it feels like when we look at deal, we can't believe where cap rates are in Texas, but I would argue like our capital loves being there, and when we talk to groups about opportunities in Texas, they love to hear about them because they believe in the growth story. So it is unique. Now, the downside is where we're protected in California, a market like California, is we do a terrible job of building new supply in many product types that can insulate us a little bit. But no, this is a wholly different cycle than the last one. Talking to people who are older, I will tell you, this feels like it's got more. There's some stuff that kind of feels like the last cycle mixed with the RTC cycle, because that one took a while too. There's some similarities with both. And it feels like if those two cycles, had a kid, this might be this cycle. But this one's unique.
Yeah, it's I feel like there's when we're raising capital, you talk about certain markets, and it's amazing to hear, gosh, if you're pitching a deal in Los Angeles versus pitching a deal in Nashville, and or something, or Atlanta or Charlotte or whatever it may be, and you just hear the lack of enthusiasm in the fourth largest economy in the world, with the biggest port in the United States.
Yes.
You would think that there would be a little bit more of enthusiasm. And I find that what's interesting is that you're going to see a little bit of like maybe contrarian plays occurring potentially, right? Because it's been so built up in all these markets that eventually, these places that they just can't be down for too long, right? And economy is really important. Jobs are really important.
And look, I mean, we obviously pay a weather tax to live here in Southern California, but you and I are both probably staring out your windows and going, look, there's a reason for that, right? And I'm a big believer in that. It probably swung too hard to the coast, and places like San Francisco got too expensive, and there was too much capital there. I'm a big sort of pendulum swing type person where I think things generally kind of go back to the middle at some point. And that even if it swings one way or swings another, it'll try to get back to the middle. I think you'll see that happening, hopefully, but it's unique. And again, this all speaks to the fact of our industry change. Like change happens, and you need to be willing to adapt. You need, especially if you're in an entrepreneurship position, you need to be willing, able to course correct and change. You need to be able to think about things differently. And that's the nature of being a real estate entrepreneur. I think it's the nature of being successful in our business.
Yeah, I agree. One thing I want to ask you, which I think I've been asking recent guests, is just the prevalence of AI and the growth of technology in our business, and all of our respective businesses in relation to commercial real estate. So what is your take, and how do you see the effect in either Waterford's business or your general perspective about commercial real estate now and going forward?
I would tell you that you can learn a lot from the next generation of professionals. We had an intern who we hired, this is 3 summers ago, who
Hmm.
was a data scientist or did data analytics at Chapman University. Owen came in and he blew me away with what he was doing using these computer programs like Python and others to study real estate markets and sift through data. And it really opened my eyes to what I think the future of our industry is going to be. If you think
Yeah.
about 20 years ago, data was like really hard to come by. Like if you think about Phoenix, let's take Phoenix multifamily. Like what is Phoenix multifamily doing? You'd have to get like a Reese report. CoStar
Yeah.
like didn't own apartments.com. Like it was really hard to know. Now, I think our industry is getting data is becoming so much more prevalent and the ability to access that data and to interpret that data. So in
Hmm.
many ways, I think it is significantly shifted our industry. I think CoStar did that pre sort of AI, but it's going to continue to shift our industry
Yeah.
where people used to make money because they knew information before others did. Like that's kind of hard now. Um, and so I think we're implementing it at our company. We've implemented it on the property management side. I don't, but then again, I'm kind of, if you know me, and I know you know me pretty well, Malcolm, I kind of tend to
Yeah.
see things from like this kind of middle perspective, right? Which is, I think it's really interesting and good. And I was doing something where we were looking up zoning for a property, and you go on Google and you go on their AI program, and it's like, I mean, they're telling you what the zoning designation are, what that zoning means. I mean, they're sifting through this data that I find is very interesting. I guess I would just say I don't necessarily seeing it replacing a lot of people or changing completely our business, but it's certainly going to make access to information a lot easier. And this speaks to
Oh
more
yeah.
of, then that's the specific knowledge you're going to need, right? And you're going to need to be able to have these skills that people are going to invest in because, like analysts, my sense is a company like yours, Malcolm, which does a lot of analytical work, you'll be able
Hmm.
to use AI 5 years from now. You'll be able to like, I might have the same analyst, but we're evaluating twice as many deals. And so it's going to
I
be even more important for people and professionals to have, knowledge bases that AI can't replace.
You recall when I use a triangle, right? Trust, competency, relationships. The ability to get the information is an incredible equalizer in this business. So
Yeah.
folks who have been able to capture or get information have had a competitive advantage in commercial real estate. The access to information, which is everywhere. So, for example, property information, capital relationship information,
Yeah.
all of those things are going to be very accessible. So,
Yeah.
I'm working with technology that will send back a report to me in 90 minutes that would have taken 2 months to capture.
Yeah.
I've got data on every, frankly, I tell the whole team here, they go, well, gee, everyone's going to know everybody in this business. And I go, yes. It's not just who you know, it's how you know how to get them to do things,
Yes.
right? And it's going to be the great equalizer. So the people that actually have the ability to deal make with the great relationships that treat people really well, who
Mhm.
are trustworthy and highly competent in doing stuff are going to really succeed because no longer is somebody going to use some type of way to get that access and
No.
use it as a competitive advantage. It's not going to be there.
Yeah, and it's also so like you asked me earlier in the call about LinkedIn, right? So I
Yeah.
been posting for a while on it for just a variety of different reasons. One where I really enjoy teaching and I really like mentoring the next generation, and I feel like the previous generation to us did an okay job of it, and I think it's our responsibility as this kind of next generation to do a better job, make
Mhm.
our industry more accessible, and I just enjoy it. But one of the ways I got some, I don't know, fame or not fame, but like notoriety was I
Yep.
started posting about like apartment syndicators, and I
Hmm.
thought that they were going to be in a world of trouble. So if you think about that, like how that came about was because I was like, how are these groups buying these deals? Well, because of now the access to information, I was on Google and you're able to
Yeah.
pull up, CLOs and bond offerings where their deal information on how they structured their debt is publicly available. Now with
Mhm.
AI, it's like way easier to do. And once you see that, I was like, oh, this is just simple math, right? Like if interest rates go up, like you're not going to be able to perform on these deals. So it wasn't rocket science. It was just getting information. And I think that's what's unique is that, through it's the whole host of means, there's so much of our industry that is so closed off. Like what type of deal structure an equity partner does. That can be like a black box to figure that out. When you can go now through all these different sources and really understand how people are structuring deals and see, like you can see publicly like loan prospectuses, right? And I'm a real estate nerd, so I like enjoy reading them to really understand like how deals got structured. Because I think that's what I tell my students is you can do a good deal if it's poorly structured, either with your equity or debt. It's actually a bad deal. And how you structure your deals, that's sort of after you pass the competency test and you can find stuff, how you structure stuff is really important.
Yep.
But nowadays, like I feel like you can't hide. And I actually think that's a good thing. But like groups who got really aggressive, we've talked about it before, Malcolm. Like it's really hard to hide now because of how prevalent information is and how it flows through. And I feel like before groups could kind of get around like, oh yeah, we had a foreclosure, but like nobody really knew about it. Where now like everybody knows about it. And so, and by the way, like your deal terms and how you did your debt, that could be public too. So it's super fascinating to see. I actually think it's a great thing because it levels the playing field a little bit. It's going to require people who are really competent, as you've said, are going to ones who are going to be successful.
Yeah, I mean, I think, a good or great real estate deal, generally, even an incredible deal will be ruined by the lack of expertise with the sponsor and its relationship with the capital. If they cannot communicate and they are not in sync with each other, a great deal can go bad. Much the same way as a bad structure, those are definitely there. And so I think in general, this is where the world is becoming much more relationship driven, not less. I really stress that. There's more relationships that we have better access to talking to each other. But I can't stress it more that you are a great person with a great personality, but also very trustworthy and really competent. And so to your point, I think hitting, the points of being an analyst at a great shop. I've always said I'd love to be my analyst here in my career because, and I think the audience knows my background, but I wouldn't have gotten in trouble, I think, as a developer if I spent more time being an analyst. So,
yes, 100%. Well, and I mean, I've said this. I think being a debt and equity analyst working for a firm like yourself could be the best place to start your career because what you're doing is you're looking at deals, someone trying to raise equity or somebody trying to raise debt, going through that, understanding that. And if you're smart and you really study that, you can see, okay, why is that good? Why is that bad? I think what's so good for what I learned in the last cycle, and I would tell anybody who's younger, is don't let a good cycle go to waste. You should be learning about. I'm actually literally my class tomorrow night. We're going to go through a couple of deals that are in default, and I'm going to go like, why did this happen? And how like you can learn a lot from a bad deal, right? And a deal that went bad, and you can learn a lot of good lessons from it. And so I think that's incredibly important. I would only say that at a certain point in time, though, if you're an analyst, you have to step up from that, and you have to be in a world where you're not just staring at a computer screen, and you're understanding how real estate works. You're understanding how things happen sort of outside the office and outside of a computer screen, how you get entitlements, how you keep a project on budget, how you raise capital, how you lease a project, how you execute a value add business plan. You've got to at some point learn those hard skills too, because that'll also pay you in spades.
100%. So I think our time is coming to an end here, John, but I can't thank you enough. I mean, hopefully the audience learned as much as I did about this, and looking forward to getting this one posted. But John, on behalf of myself, the rest of the team here at Way Capital, we want to thank you for being our guest on The Edge.
Yeah, of course, my pleasure. I really enjoyed it.
All right, John, go Cats.
Go Cats.
Thanks for taking the time to tune into our latest show. As always, you can find us through our YouTube channel at youtube.com/@wayontheedge or at our website at www.waycapital.com. Until next time, keep working on the edge.